You want to dissolve your company but don't know where to start? You might think dissolution is a single statement you file with the state. But in reality, it is a multi-step legal and tax process, and even if you miss one step, you will also encounter several penalties and interest later. Unfortunately, many service providers only do the state-level dissolution and leave the entrepreneur with later IRS penalties, interest, and unfiled returns. First of all, you need to approve this dissolution internally. Secondly, you need to file your dissolution statement with the state. You need to ensure you have paid all franchise tax and annual report fees so that the state can approve your dissolution. Then you need to file final federal tax returns. This is the part generally founders miss, and even if you had no income for the previous period, you are still required to file your federal tax return and tick the box saying it is your final return. After that, you will also need to freeze your EIN, and you will write a letter to the IRS saying that the EIN will not be used anymore by either you or any third party. At the fifth step, you need to close all your accounts and membership. So you need to inform your stakeholders like banks, marketplace representatives, and you should also cancel all your subscriptions. Even if you are no longer operating, until you notify them, they will still continue charging you. At step 6, you also need to keep all this documentation in your records at least for 7 years. If IRS comes to an audit later, you will also need to show all this documentation clearly and without any missing one.